You wake up this Monday morning, Nikkei is hovering around 68,557 after a 1.2% gap higher on Friday. And the weekend headlines are screaming one thing: Japan is calling its capital home. A massive pension shift into domestic assets has just been signaled. Yen is rallying, JGBs are catching a bid, and the Nikkei is caught in the middle of a structural flow that could either ignite a melt-up towards 72,000 or morph into the cleanest bull trap we've seen this quarter. This week has one danger zone and one 3 to 5 day opportunity. I'll show you both right now, stay to the end. I'm giving you 2 Monday scalps and 1 swing trade that can run the next 3 to 5 days. But first, you need the weekly verdict. The 3 to 5 day structural bias is cautiously bullish, but we are fading the initial euphoria until the Nikkei proves it can hold above the weekly pivot at 69,771. The monthly and weekly trends are screaming strong buy. ADX on the weekly is above 42, that's a runaway trend. Price is trading miles above every major moving average. The 50-week is at 55,454, the 100-week at 48,728, the 200-week down at 41,954. This is not a market that's even tested its key supports in months. But the daily chart has gone neutral, the 4-hour is neutral, the 1-hour is neutral. That tells you the immediate momentum has stalled. We are consolidating right at the upper edge of a weekly value area, and the RSI on the daily is 70.4, perched right on the overbought line. The stochastic is at 93, deeply overbought. Williams %R is at -6.5. I've seen this set up 100 times. The trend is your friend until the flow flips, and the flow flips when the herd gets too comfortable. Write this number down. If the Nikkei loses 67,581 this week, the whole monthly structure resets. That is the weekly S1 and the last line before the weekly trend angle breaks. Below there, 65,419 becomes the new magnet. But here's what the herd doesn't see yet. The weekend pension news was not a surprise to the big players. Institutional flows have been front-running this for 2 weeks. The real question for the next 5 days is whether the retail and late institutional chase creates enough liquidity to push through 69,771, or whether the yen strength, which kills exporter margins, caps the rally and triggers a stop hunt. The yen is the shadow driver this week. When Japan calls capital home, the yen strengthens. A stronger yen compresses Nikkei earnings expectations. That's the trapdoor. The market has priced in the flow but not yet the currency backlash. Here's the weekly technical deep dive. I want you to pull up your charts with me. On the weekly time frame, the Nikkei is riding a 5-period MA at 68,498. Price closed Friday just above it, and that MA is now the short-term momentum anchor for the entire week. The 10-week moving average is at 66,218 and rising fast. The 20-week is at 62,665. This moving average stack is textbook bullish expansion. The 5 above the 10 above the 20 above the 50. The trend is not just intact. It's accelerating. The weekly MACD is printing 4,807, and the signal line is sloping higher with no immediate rollover. There is no bearish divergence on the weekly MACD yet. Price is making higher highs and the MACD histogram is confirming. That's your macro pulse. It says that over the next 3 to 5 days, the path of least resistance remains upward unless we get a daily close below the 20-day moving average, which currently sits at 62,665 but is too far away to matter for this week. For this week, the daily 5-day MA at 68,498 and the 10-day MA at 66,218 are our moving ropes. Now, zoom into the daily. The daily chart shows Friday's candle as a solid green body but with a visible upper wick near 68,900. That wick tells you sellers are present just ahead of the psychological 69,000 handle and the weekly pivot at 69,771. The daily ADX is still above 40, strong trend, but the average true range is 3,628 points. That's enormous. The Nikkei can swing 1,000 points in a single session without breaking a sweat. That ATR is your risk gauge. It means tight stops will get eaten, and you must size accordingly. The daily CCI is at 95 and curling lower, hinting at a short-term loss of momentum. This is the subtle signal most traders will miss until Wednesday. What I'm watching is a potential hidden bearish divergence on the 4-hour time frame. Price has been grinding higher, but the 4-hour MACD histogram has been printing lower highs since late last week. It's not a confirmed reversal signal yet, but if we see a failed breakout above 69,771 midweek, that divergence will become the story. That's the trap. Now let's talk levels. On the upside, weekly resistance stands at a 171,934, then a 274,124. The weekly pivot point is 69,771. That's the fulcrum. The daily 4-hour chart shows a congestion zone between 68,200 and 68,900, which is exactly where we are now. Support is clear, S1 at 67,581, S2 at 65,419. The weekly pivot is the line that separates a choppy consolidation week from a breakout week. If we open this Monday above 68,500 and start grinding towards 69,000, the pivot at 69,771 will act as a massive magnet. Above that, 71,934 is the measured move target, and given the ATR, that's achievable in 2 strong sessions. But if the yen strengthens too quickly and we see a rejection at the pivot, the Nikkei could slide right back to 67,581 within 72 hours. That is the weekly range envelope that I want to tie this to cross-asset flows. The Nikkei this week is the risk asset shadow. If you look at S&P 500 futures, they're also consolidating near highs, and the VIX term structure is complacent. But Japan's story is different this week because of the domestic flow catalyst. A pension shift of this magnitude doesn't just disappear after one weekend headline. The Bank of Japan and the Government Pension Investment Fund have been telegraphing this for months. What's happening is a repatriation wave that could force Japanese institutions to rotate out of foreign bonds and equities, and back into domestic stocks and JGBs. That is yen positive and Nikkei positive in the immediate flow sense. But as I said, the yen strength is the kryptonite. Watch dollar yen. If dollar yen breaks below 140 this week, the Nikkei's upside potential gets cut in half. I'll be monitoring the dollar yen chart alongside the Nikkei every hour this Monday. Here's what most traders won't realize until Wednesday. This week's real volatility catalyst isn't a Japanese event, it's US CPI on Wednesday. The Consumer Price Index release will reset the Fed expectations and dollar yen will move violently. If CPI comes in hot, dollar yen spikes, yen weakens, and that's jet fuel for the Nikkei to smash through 69,771 and run to 72,000. That's the melt-up scenario. But if CPI is soft, the dollar dumps, yen surges, and the Nikkei will struggle to hold 68,000. That's the trapdoor. The market right now is positioned for the melt-up. The weekend's news has created a one-sided euphoria. The weekly commitment of traders' data shows large speculators net long Nikkei futures at elevated levels. That means there is a liquidity pool below recent swing lows ripe for a stop run. The smart money will let the early week pop happen, then gauge the yen reaction. This is the narrative web for the next 3 to 5 days. Monday and Tuesday will be about repositioning and absorbing the pension news flow. Wednesday is the fuse. Thursday and Friday will either see trend continuation or a sharp mean reversion. My 3 to 5 day directional lean is bullish while above 67,581, targeting 69,771 initially and 71,934 on a weekly close above the pivot. The invalidation of this entire bullish thesis is a daily close below 67,581. If that happens, the weekly trend doesn't break, the monthly trend still holds, but the near-term structure flips bearish and we target 65 for 19. I want you to interact right now. Do you think the Nikkei closes above 69,771 this Friday? Comment above or below. I'm tracking consensus for the week. Drop your call. Now we move into the setups. Most people skip the planning phase. That's exactly where this week's money is made. Keep watching, because I'm about to give you the exact entries, stops, and targets for 2 Monday scalps and 1 swing trade that could define your entire week. Strategy 1. The Monday opening scalp, scalping, high probability. The first setup targets the first 1 to 3 hours of Monday's Tokyo session. We are coming into the open around 68,557 after a strong Friday. The Asian session high from Friday was roughly 68,920, and the Asian low was near 68,100. Overnight futures are likely to open near the cash close, but watch for a gap. Here's the play. If price retests the 68,500 level, which is the 5-day moving average and the midpoint of Friday's range, and a 5-minute candle closes with a bullish rejection wick and the next candle takes out its high, that's your trigger. This is a momentum continuation scalp riding the early session flow. Entry at 68,550. Stop loss. Goes at 68,350, just below the overnight low and beneath the 5-minute support zone. That's a 200-point risk. Take profit 1 sits at 69,050, which is just ahead of Friday's high and the psychological 69,000 zone. That gives you a 500-point gain, a risk reward of 1 minute and 2.5 seconds. If momentum is violent, you can stretch a runner to 69,500, but take partials. The Monday opening scalp is instantly voided if a 5-minute candle closes below 68,350. That signals the session is distribution, not accumulation, and you step aside. This setup exploits the early institutional positioning that often drives the first hour after Tokyo opens, especially with a fresh weekend narrative driving flows. The Monday opening scalp entry, 68,550, 5M bullish reclaim above Friday's midpoint, stop loss, 68,350 take profit 1, 69,050 risk, reward, 1:2.5 invalidation, void if 5M candle closes below 68,350. Strategy 2. The Monday liquidity grab, scalping, counter noise. The second scalp is a counter noise play, designed to catch the stop hunt that often unfolds after the initial Monday swing. Here's the psychology. The weekend pension news has retail and late longs piled in near Friday's highs. There is a cluster of stop-loss orders sitting just below Friday's low, which was around 68,100. The market loves to sweep those stops before resuming the trend. So if we see a sharp, fast move down that pierces 68,100, wicks down to 67,900 or 67,800 on the 5-minute chart, and then immediately recovers, closing back above 68,100 within the next 2 candles, that is the liquidity grab. You enter on the reclaim of 68,120 with a market order or a limit order at 68,120. Stop loss goes at 67,880, just below the wick low. That's a 240-point risk. Take profit 1 is 68,600, which is the initial resistance and the level the market just broke down from. That's a fast 480-point scalp, a 1:2 risk reward. If the grab is particularly vicious and the recovery candle is massive, you can hold for 68,900, but take profits quickly because this is a noise trade, not a trend trade. The invalidation for this setup is simple. If the price drops below 67,880 and stays there, the liquidity grab failed and a deeper sell-off is underway. You do not want to be long. This setup requires aggressive execution and a calm trigger finger, because the stop hunt happens in seconds, not minutes. The Monday liquidity grab entry, 68,120, 5M reclaim after piercing Friday's low 68,100, stop loss, 67,880 take profit 1, 68,600 risk, reward, 1:2.0 invalidation, void if 5M candle closes below 67,880. Are you scalping Monday or swinging the week? Comment scalp or swing. Let's see who's built for this market. Strategy 3. The 3 to 5 day swing, trend alignment, now the swing trade. The one that lets you capture the core move of the week without staring at 5-minute candles. The structural bias is bullish above 67,581. We want to enter on a daily confirmation that the pension flow and yen dynamic are aligning for a breakout, not a trap. The trigger condition. is a daily close above the 60-period moving average on the 4-hour chart, which is not a standard MA, but I'm giving you a clean price level. Right now, the 4-hour 60 MA sits at 67,900 and rising. More practically, the level we need is a daily close above 69,000 with conviction. But I'm going to give you an entry that front-runs that if conditions are right. If we see the Nikkei pull back early this week to the 67,800 to 68,000 zone and hold, especially after a successful liquidity grab, and the daily RSI resets below 70 but stays above 60, you can enter long at 68,200 with a stop loss at 67,580, just below the weekly S1 and the structural invalidation level. That's a 620-point stop. The conservative target is 69,700, right at the weekly pivot, for a 1,500-point gain, a risk-reward of 1 minute and 2.4 seconds. The stretch target for Friday is 71,400, which is just inside the weekly R1 at 71,934. That's a 3,200-point run, a 1 minute and 5.2 seconds risk-reward if the melt-up gains traction. But here's the critical rule. Once price reaches halfway to TP1, that's around 68,950, move your stop to break even. Then trail the stop using the 5-day moving average on the 4-hour chart as your trailing level. Once the price is above 69,771, you can trail the stop to just below that pivot. The swing trade is invalidated on a daily close below 67,581. If that happens, you exit immediately and reassess. The beauty of this trade is it captures the weekly trend without micromanaging, but it respects the yen risk. Remember, the pension flow is a medium-term story. Even if we get a shaky start, the underlying bid will manifest if dollar-yen stabilizes. This swing is for the patient trader who understands that the Nikkei's 3,600-point ATR demands wide stops and strong conviction hit 3 to 5-day SWNG entry, 68,200, on pullback to 68K zone with RSI reset, stop loss, 67,580 take profit 1, 69,700 take profit 2, 71,400 risk. Reward, 1 minute and 2.4 seconds, TP1, 1 minute and 5.2 seconds, TP2, invalidation. Void if daily close below 67,581, risk management pulse. This is not optional. Never risk more than 1 to 2% of your account on any single trade. The Nikkei's 3,600-point ATR means a 600-point stop is barely 1/6 of a daily range. Do not over-leverage. Holding through Wednesday's US CPI requires tighter sizing. Stops are non-negotiable, especially on the swing. The market doesn't care about your pension narrative. It cares about liquidity. This is how you survive to trade the next big weekly move. Here's the most critical level to watch for the entire week, the one that separates the weekly winners from losers, 69,771. If the Nikkei prints a daily close above that level, the melt up towards 72,000 is confirmed, and any dip becomes a buying opportunity. If we stall there and form a daily shooting star, I'll be looking for a reversal back into the 67,581 support. That's the weekly range, 2 levels, 1,200 points apart, with a pension flow and a CPI report fighting for control. Friday's wildcard. If the Nikkei closes the week above 71,000, the monthly trend enters vertical acceleration and we could see 74,000 by the following week. But if dollar-yen collapses on a soft CPI, the Nikkei could close back at 67,500, trapping all the latecomers. I'll have the updated blueprint for you this Sunday, where we'll review what happened and map out the following week's trade. If you want last week's recap to see how the 65,000 breakout held perfectly into Friday's close, that video is live now. Tap the end screen. Then hit the bell so Sunday's next week ahead alert lands before the open. Hold the like button and subscribe. Every signal helps the algorithm bring you the levels that define your week. I'm the founder of Alpha Market Meridian, and this is your Monday Institutional Blueprint. I'll see you on the charts.